The Canadian housing market has become increasingly unaffordable with prices skyrocketing in major cities. This has made it difficult for first-time home buyers to enter the market and achieve the dream of home ownership. However, there is a new savings program in Canada that aims to help this dream of home ownership to become a bit more attainable. And this is a savings account called the First Home Savings Account, FHSA. Make sure to watch until the very end of the video to find out everything you need to know about this new savings account. Hi, my name is Irene and I'm a CPA here in Canada. I post videos explaining important accounting and tax concepts using simple language to help Canadians better understand accounting and taxes. Make sure you hit that like and subscribe button for more. The First Home Savings Account, FHSA, was first introduced in the 2022 federal budget and is expected to be available to Canadians in 2023. The FHSA will allow Canadians to save up to $40,000 tax-free. You probably have heard of the other registered savings accounts like the TFSA and the RRSP. What's interesting about this new FHSA is that it takes the best features of both of the other registered accounts and combines it into this new FHSA. So similar to an RRSP, the contributions made into an FHSA will be tax deductible, meaning that it will lower your overall personal tax bill. Similar to a TFSA, the withdrawals made from your FHSA will be tax-free. Similar to the TFSA and the RRSP, the FHSA is an account in which you would deposit cash into and then use the cash within the account to buy investments such as stocks, bonds, ETFs, GICs, mutual funds, etc. Please note that since this is still a new initiative, there may be changes to come and I'll keep you updated. To be qualified to open an FHSA, you must be at least 18 years old, a resident of Canada, and you must meet the first-time home buyers test, which means that you cannot have owned a home in the year that you open the account or in the last preceding 4 calendar years. The FHSA allows for a maximum annual contribution of $8,000 per year, with a lifetime maximum contribution of $40,000. So assuming you contribute the maximum $8,000 per year, you will reach the maximum lifetime contribution of $40,000 within 5 years. Any unused contribution room can get carried forward into the future years. For example, if you contribute $5,000 in year 1, that unused contribution room of $3,000 will be carried forward into the future years. So now in year 2, you can actually contribute $11,000 because you have your $8,000 annual maximum, and then you also have the 3 carried over from the previous year. In order for your FHSA withdrawals to be non-taxable, the following conditions must be met. You must be a first-time home buyer, as outlined earlier in this video. You must reside in Canada when you make the withdrawal. You must be using the funds to purchase a qualifying home that you're going to be using as your principal residence, meaning that it's going to be a home that you live in, not an investment property. And lastly, you must have a written agreement to buy or build your home in Canada by October 1st following the year of the withdrawal. If your withdrawals do not meet these criteria, it will be considered taxable and the amount withdrawn will be added onto your personal tax return to be taxed at your marginal tax rate. To make a qualifying withdrawal, you must issue a request from your FHSA issuer to confirm your eligibility. Whether the withdrawal is qualifying or non-qualifying, your FHSA issuer will issue you a tax slip for the amounts withdrawn. Unlike the Home Buyers Plan, HBP, you do not need to repay the withdrawal amount back into your FHSA. Once you open the First Home Savings Account, you will have 15 years to find a qualifying home to purchase. However, if you turn 71 years old before this 15-year period, your account will also be closed. Any savings not used will be transferred into your RSP or your RRIF, your RIF, or can be withdrawn on a taxable basis. The amounts transferred to your RSP upon the closing of your account will be transferred into the RSPs without affecting your contribution room, which also means that you won't get additional deductions on your personal tax return because it won't be doubling it up. Unfortunately, the FHSA does not make purchasing a home any more affordable because it doesn't directly tackle the issue at hand, which is rising housing markets. Additionally, if you're planning to withdraw money in the short term from your FHSA, you might want to consider investing in more safer investments because you will not have the benefit of a long time horizon to take advantage of significant compounding interest, nor do you have the benefit of being able to ride out the dip. Nonetheless, the FHSA is a powerful tool to help you save for your first principal residence. Thank you so much for watching until the very end of the video. I hope today's video was helpful. Over here, there is a video that YouTube thinks you're really going to like, so I'll meet you there.